Most of the time we focus on when to buy, which companies we should buy, and what the right price is. It's easy to find a ton of videos on the internet talking about buying stocks, but when we search for information on when to sell, the scenario completely changes. That's because selling is the single hardest step of any investment. It requires study, defined goals, and a solid investment framework. It's where the most costly mistakes are made, and it's the reason why most investors fail. I've made hundreds of investment sales over my career, and there are some things you can just learn from a textbook. Only experience will tell you. That's exactly what I want to share with you in this video. I'm a long-term investor, but even I know there are times when you absolutely have to sell. Stick around because I'm going to share the 3 simple rules I follow for selling. And trust me, they will change the way you think about your portfolio. We have all been there. You buy a stock, it doubles, and you feel like a genius. You sell to lock in that 100% gain, pat yourself on the back, and then watch in horror as the same stock goes on to become a 10 bagger or even a 20 bagger. Selling too soon is one of the most destructive things you can do to your long-term returns. The opportunity cost is absolutely brutal. So, how do you perfect this art? I didn't reinvent the wheel. I turned to one of the investing greats, Philip Fisher, and his phenomenal book, Common Stocks and Uncommon Profits. His philosophy on selling is so powerful and so simple that I've adopted it as my own. Here is the key. If you bought a truly great business, there are almost no good reasons to sell it. My default action is to hold for decades, because that long-term holding period is my strategic advantage. However, there are 3 and only 3 acceptable situations where selling is the right move. Rule number 1, you made a mistake. It happens a lot. You do your research, but you simply misjudge the company. Maybe its competitive advantage wasn't as strong as you thought, the management team made poor decisions, or its future prospects have fundamentally deteriorated. If the business is no longer the high-quality company you thought you bought, you sell. Acknowledge the mistake and move on. For example, 2 years ago I bought a company. I thought it was a solid business with great growth prospect. It turns out its revenue started to flatten, and instead of reinvesting in the business, they started investing in Bitcoin. That was not my original thesis for owning the company, so I decided to sell. Sometimes the opposite happens too. We see the fundamentals of a company deteriorating, but we hold on, hoping it will get better, and we end up making a bigger mistake. You get emotional attached to stocks, and that's a big error. In number 2, your personal circumstances have changed. This has nothing to do with the stock and everything to do with your life. You might need the money for a down payment on a house, a medical emergency, or to fund your retirement. If you need the capital, you sell. Your life always comes first. And in number 3, you have found a demonstrably better opportunity. I will repeat, this is very important. Demonstrably better opportunity. This is the trickiest one. It's not about selling a great company to buy a slightly better one. The new opportunity must be significantly and obviously superior, offering a much higher potential return for a similar or lower level of risk. This is a very high bar, and it prevents you from constantly churning your portfolio and selling your winners just to chase something new and shiny. Most of my sales are usually justified under this rule. For example, an investment I own increases a lot in value. Maybe it's already a 3x or 4x return very quickly, and I believe the stock is now overvalued. At the same time, I find another great company on my watch list that is significantly undervalued. If the risk reward for this switch is really in my favor, I should do it. Another example. One of your stocks increases so much in value that it becomes a huge position in your portfolio. Let's say 40%. You are no longer comfortable with so much of your net worth tied to a single company. In this case, trimming the position to decrease your risk is a good move. If a stock I own doesn't fall into one of these three categories, I do nothing. I try to let my winners run, but this is something I'm continuously trying to improve, and you should too. So, the next time you are thinking about selling a stock, ask yourself, does this decision fit one of these three rules? If not, the best thing you can do is probably nothing at all. Holding on to great companies for the long term is the true secret to build health. It takes discipline, patience, and willingness to be wrong sometimes, but by having a clear framework and sticking to it, you can avoid the emotional traps that cause most investors to sell their winners too early and hold on to their losers for too long. Let me know in the comments below. Have you ever sold a stock you later regretted? Share your story, and if you found this video helpful, be sure to hit that like button and subscribe for more insights on investing. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.